Happy New Year, everyone. Welcome back to Nucleus Investment Insights. Just a relatively quick one today. We wanted to run through quickly what worked in 2024 and what does that mean for 2025. Sometimes you go through these periods where something works really well in 1 year and then you get a reversal, and other times it's just a continued sign of growth. And so I just wanted to sort of hit on a few of those, a few of the key sectors up and down, and just sort of looking, what is there opportunity for growth, or are we looking at sort of repeats, and what are the factors as well from an investment perspective that's working. Quick reminder, everything you hear today is general advice, not personal advice. If you do want personal advice, feel free to give us a call or register on the website, and we can have someone talk to you about what might be right for you. And with that, I will jump straight into some of the performance data, and I'm going to hit up the international in particular. So the Aussie side is we've run through a few times about how we don't have that. I guess our outlook for Australia isn't quite as robust. We've got a lot more international than what we do Australia at the moment, and so. And that certainly ran very well during the 2024. But the real thing for it was that size matters. So what I'm going to start with is this S&P Global 100, and then just sort of also looking currency wise. So US dollar, it was up sort of 27% over the year December, but that's sort of almost 40% in Aussie terms. A little bit higher again in yen, and so as a US dollar, that US dollar strength really sort of drove better performance if you're investing in different currencies within that. But the other major thing was that size really matters, and so we've got these direct index portfolios that we run, and what they do is they sort of just focus on a certain number of stocks. And so the idea is you buy this sort of direct index. Which is very similar to an index fund, but you're just buying all the individual securities, and then you can sort of customize that, add stuff in, and take it out. And so, if you look at that, you've got this direct index 15, which was just, and I'm comparing this again to the S&P Global. It's sort of like 20% better performance in that than what you got in the already strong S&P Global. And the direct index 40, which is sort of probably one of the more common ones, was outperforming by 10%. And you can just see there's just this linear, you took away stocks, I guess. You started with the 15, and you just got a better performance than all the way up. And if you looked at the MSCI World, which is sort of 1,600 stocks, that was sort of 10% worse than the S&P 100 sort of global. And this is pretty extraordinary. You always see differences between these, but it's pretty extraordinary you ever get this much difference between the performance. And a lot of it all comes down to just that the top sort of 7 odd tech stocks. And so basically, if you were in this direct indexes, it just meant with only 15 stocks versus 75, it just meant you had a greater exposure to all those top stocks, Microsoft's and Google's, and most importantly NVidia, in terms of just getting that performance that really sort of drove throughout the year. So so very much that size was the most important factor you could get throughout 2024. The next thing then is that it that sort of flowed through very much to your choices that you could make in terms of, let's say we want to add stuff into our portfolio and get better performance. So the same type of factor where you said, well, you could do 40% better in this portfolio if you had an artificial intelligence tilt. So you're up well over 40%. And then the next sort of biggest ones you had was video gaming, United States in general, North America, which is obviously pretty similar to United States, large tech stocks, growth stocks, communication services, which has a lot of Meta and Alphabet or Google within that, and then the quality stocks, which again has all those top tech stocks. So basically, the tilts, you really just try to get I guess what we're saying for 2024 is if you had more NVIDIA in your tilt, so let's say you had an AI tilt, then it obviously had one of the highest amounts of NVIDIA, and so that did better over that time period. At the other end of the spectrum was pretty much all commodities. As you run through it, so I'll exclude luxury goods. That was one certainly within that had a poor performance over that time period. But coal, agribusiness, materials, uranium, copper, battery supply chain, which makes up a lot of lithium, and then lithium stocks themselves. So that's sort of the worst thing you could own over that time period. And then, so the question always comes back to these in terms of how you're looking at them is saying, well, is there is this something where it's a bounce back year, or is this something where you can expect trends to continue? And one of the factors that sort of flowed very much into the performance of NVIDIA and that whole sector was that we actually saw the earnings come through and quite strong growth in those earnings. So the valuation metrics actually don't look that expensive at the moment. And so what I'd say, based on that type of scenario, is that you're looking at a period where as long as that growth keeps coming through, then you're likely to continue to see reasonable performance. And the issue you really need to be watching for is when that growth starts to slow down or stop within that sector. If we look at the what could you have taken out of your portfolio and what would that done? Now keeping in mind that usually taking things out of a portfolio doesn't make that much difference to the overall performance of the portfolio. So usually, you'll cut something like out of your portfolio, like fast food or something like that. Ordinarily, that makes a relatively minor difference to the portfolio. This year wasn't the case. You had some, and actually, I guess these lines are a little bit misleading upon, because I've done some comparisons. But I guess the best thing you could take it out of your portfolio was animal testing. And ironically, the reason is not so much because that was a good thing to take out. It was more that just that's actually quite a large sector, and it takes out a lot of the healthcare stocks. And healthcare didn't have a good performance, so that was one part of it. But actually, the bigger contributor was you actually just ended up, because you took out a big chunk of the of your sector that wasn't NVIDIA and Microsoft and all those. You just ended up with lots more of those Microsofts and NVIDIAs and Metas. And so therefore your performance was that much better. So all top three of those was all about healthcare. Then you've got some things like some fast food, fossil fuels, and some of the energy stuff that they did have a poor performance over the year. And so cutting those out of your portfolio helped. But again, it was sort of more about just how could you get more of those tech stocks into your portfolio rather than not. And at the other end of the spectrum, if you were ex-US, you really copped it, relative to the index. That's down sort of 20% versus the index, and cutting out information technology stocks as well was a poor choice for the year. But coming back to that whole idea around NVIDIA, I've got a chart up. I just want to show which is the price to earnings ratio for NVIDIA at the moment. And there's a whole bunch of lines on this chart, but there's two I want to focus in on. One is the red line, which is the next 12 months, so the forecast year. And the other one's the yellow line, which is what we call the second 12 months, but basically looking out sort of between 12 and 24 months. Now, if you look back, this is over 25 years, this chart. But if we focus on sort of the past, say, 10 years of that, NVIDIA is currently on 32 times. That's not particularly high for where it's been over the last 10 years. It's quite frequently been up around 50 or 60. So, not particularly expensive. It's not right at the bottom end of the range, but it's not that far off. And the second 12-month numbers are pretty close to the bottom end of the range. They're sort of at like 26, 27 times, which is the same price you pay for Commonwealth Bank at the moment. And a very different growth profile that you're looking from those. and so part of the and I think this chart as well sort of shows really where the gains, partly where the gains came from, is a sort of so you can sort of get natural growth from as earnings or fundamental growth. So the earnings double or more than double as they did in NVIDIA's case, and the valuation doesn't change. That's sort of one part of it. And then you can have valuations improving or valuations getting worse. Now for NVIDIA, you had basically both of it. So you actually started at a bit of a low point at the start of 2024. As you can see from this graph, it's sort of trading on the sort of low 20s in terms of the forward PEs. And so you had the double whammy of that sort of going from sort of low 20s up to 30 times, plus this exponential growth in earnings that we're seeing, where they went from $2 a share to $4.20 a share in terms of the next 12 months earnings. And while the pace of the upgrades has slowed a little, it's still looking like quite extraordinary growth, and you're still looking very strong growth in terms of the earnings. And I've just sort of got a chart up now to sort of showing that that those earnings forecasts are just going vertical within NVIDIA. If you look at we have a whole bunch of different measures. We look at cash flow and some balance sheet and yields and all these other factors that fall into it. If you sort of take all those into account and then put it on a scale of where it sits versus other companies within the sector. So at the moment, you've got it at the 83rd percentile. For the most of the past 10 years, it's been pretty close to the 100th percentile. So it's sort of, or certainly in the 95th to 100th percentile, so sitting up in that really high range. So it isn't cheap, but it's cheaper than it's been over the last 10 years on a relative basis. And again, this probably even more starkly shows that 2024, got down to the sort of the 65th percentile at the start of last year, which is part of the reason for that, that big jump. And that sort of gives you some hope not some hope, but some I guess some expectation that this is more sustainable than a stock that just rallies up to the valuation levels that have never been seen before. So I think if you look at, say, something like a Tesla, that's the case. I haven't put the Tesla chart up on this, but because basically it's a straight line along the top, which is basically it's trading at that massive percentile versus its peers. Whereas something like NVIDIA, you are seeing that earnings growth, and you're seeing relative to its relative valuation is not that expensive. When you can buy the highest growth stock in the market, and you're almost on a cheaper multiple than Commonwealth Bank in Australia. It's a reflection. Commonwealth Bank is expensive, but it's a relatively positive sign that you're not. It's while there's some arguments about whether bubble or not bubble. When the fundamentals are improving, there's less chance you're in that sort of bubble. So some other stocks that are on a sort of similar path, Meta is another one that had a pretty good year. That's sort of trading on 23 times earnings, so pretty close to market multiple in terms of Meta's earnings. So pretty close to what you'd pay for the average stock within the US, and obviously down on what it used to trade at in sort of early 2010s, but not dissimilar to where it's traded for a lot of the last sort of 10 odd years, and a little bit cheaper actually than that for some of it. And Meta's also got one of those ones where if you stripped out some of the spend they've been doing on the virtual reality, which is basically they're spending a lot of money and getting no revenue from it. If you actually sort of took that out and said that whole division's worth zero, let's just ignore the earnings from it, it looks way better again in terms of these. Amazon, it's a tough stock to look at on a valuation basis, or certainly forward earnings and a whole bunch of other, and cash flows and all these other factors, because of the way they sort of gave up margin in terms of chasing growth. But sort of having said all that, it is as cheap as it's been anytime in the last whatever 2 decades. If you especially look at the second 12 months worth of earnings, you're sort of back to sort of 25 times, which is basically as cheap as it's been any time in its history. So that's slightly a reflection that they are actually starting to make more money and quite decent profits now. But also just, I guess, another sign that, look, while that's an expensive multiple to pay, it's not. It's certainly not it's not that different to what we're seeing in terms of market multiples within that. So that was Amazon. Microsoft's another one. This is probably more. It's a little bit tougher in that it's been trading at sort of that 30 times earnings plus, and that is starting to get quite expensive. So it's probably 20% more expensive than most of these other ones we've been talking about on this. But they've had the benefit that they just keep growing those earnings, and those the last 4 or 5 years have been a pretty steady and straight sort of upward rise within the earnings. And so as long as you keep still seeing that earnings growth come through from Microsoft, and they're sort of very much at the forefront of a lot of the artificial intelligence growth, that it is, that's while you're paying sort of top dollar for it, it's you can have a little bit more comfort, I guess, within that you are getting the fundamental growth coming through. So that's sort of just, I guess, the broad overview that I wanted to give in terms of what happened last year. The other thing to look at is what we call factors. And the idea with the factors, apologies, that's a little bit off kilter on the slides, but the idea with the factors is there's a couple of quant things you can look for that tend to give you an indication of what's working and what's not working. And so one of the things in the last 12 months that really didn't work in the US was this idea of valuation. And I don't want to downplay valuation because it is important. But there's this, if you just take a pure value look at the market, so you're basically saying, give me the cheapest stocks that I can find in the market. What this chart is showing is it's basically saying if I bought the most expensive stocks, the top quartile, so the top 20%, quintile, sorry, the top 20% of stocks, and then I short sold the bottom, the cheapest stocks, I bought the cheapest stocks and short sold the most expensive stocks, what would my return have been? And you would have lost 20% on that strategy last year, and that's after 26% loss the year before that. And so I guess what I wanted to highlight within that is value niche. In my view, value needs to have another axis. Like, you don't just go out and decide to buy the cheapest thing possible. So regardless of whatever you're buying, let's say you're buying a car, if you go out and buy the cheapest car you can possibly buy, it's probably not going to run. It's probably going to have all these major problems, and you're going to have to spend all this extra money to get the whole thing working again. You actually go, well, I want to. You might still want to buy the cheapest car relative to some sort of reliability gauge. Is this thing actually going to work? Is it going to be from A to B, and all those types of things? And so I might not go out and buy a $1 million supercar, because that might, be pushing it in the other direction. Is, if I just need to run down to the shops every now and again, I don't need to spend $1 million buying some supercar that can do hundreds of kilometers per hour. And there's some sort of happy medium between the two, where you're trading off that price and quality. And I think that's where the value measure sometimes gets mistaken within this. And quite often what you do end up with in that value measure is a lot of stocks that don't have a lot of control over their own margins. So energy and commodities are in particular. And then a lot of things like materials and sort of these products where if you're producing, say, housing tiles, they're pretty similar to, your housing tiles to everyone else's. If you suddenly want to put up your prices by 30 or 40%, people will probably just go to your competitors. And so you just don't have that same pricing power over it. And so you saw within those stocks in that 2022, when we had this inflationary push, that was when these stocks finally managed to really get some pricing power. And you sort of had this massive outperformance of those value stocks in that 1 year. but then you're back to underperformance. And that's sort of pretty typical in these stocks, where you do get a lot of underperformance within value, and then in 1 year, all of a sudden you do great when everything else is doing quite poorly. So that's so we've had a couple of bad years for value. The big ones for last year was really mixture of historical growth, capital efficiency, and volatility. And those ones tend to be, well, excluding the volatility side, those tended to be your stocks that are your NVIDIAs and your Microsofts and those ones. They tend to have that growth factor to it, and they tend to earn some really high margins and some really high returns on equity. And so, cracking years for those. Earnings quality, which is often similar to those types of measures, that also had a relatively good year, but not as good as some of those others. And then the other one was this idea I spoke about before, that size matters. So size in this case tends to be more about small caps versus large caps. And we've had that second year of small caps underperforming. And if you look over the past 10 years, you've basically had 2 years, 2022 and 2016, where small caps did a little bit better than large caps. A couple of years of being even, and every other year it's been run down. So, arguably at some point that would reverse. But the problem for small caps has been they just haven't been getting the earnings numbers coming through over the last year that you've seen within the large cap stocks, which is why that we're seeing that sort of extreme divergence. I've got some Europe numbers as well, just sort of showing up to sort of look at what's different from between Europe and US. So Europe growth again was a key one. Analyst expectations is another strong one over there, which is where actually I haven't shown the analyst expectations on that first one. Sorry, or it's come off that graph. That was good. That was analyst expectations was very good for US as well. But analyst expectations is where you're basically looking for stocks where you're getting upgrades. And if you're getting upgrades, you're in buying those stocks. So very much in Europe, we can see you want a stocks that either had grown in the past, or you're getting analysts upgrading their numbers for current years. And that sort of gave you that performance in 2024. And we'll argue that's going to be another strong factor 2025, is that it's the markets are expensive. But if you can find the ones that are growing their earnings and seeing earnings upgrades, then we think you're going to continue to do well. But that's that real key focus for us now, is when you price to not quite perfection, but pretty close to perfection, you really need to be paying attention for when outcomes aren't going to be perfect. And so, yes, that's sort of our outlook for 2025. Well, that's some thoughts on 2024 and some outlook for 2025. So if you do want to put some of these factors into your portfolios, we've got these tilts you can run on our portfolios, and I'll jump into that in just a second.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So, so what I'm going to show here is part of a report that we've got coming out later on today or early tomorrow, just in terms of showing you, if you're looking for particular factors to try and get into your portfolio, what can you put them in? So what are the tilts? So the idea is we've got these portfolios, whether we're managing it or these direct index portfolios, and then you can add things in and take them out. And so what can you add in and take out to get some more value? So the key ones, the big sector, coal stocks is up there. Now, I just want to highlight, for resources companies, often value metrics don't work well. And this is actually a perfect example of one of those where coal stocks look really, really cheap. And the reason why they look really cheap is because coal prices have been really high, been quite high, and people are looking at them saying, "Hey, those coal prices can't last," and the coal prices are coming off, and so therefore you're looking at these earnings that are quite high, but people are saying, "Well, they're not sustainable earnings," and so therefore they might look like they're cheap because let's say you're doing a price to earnings ratio, you might be sort of 5 times earnings or something like that. But if people are saying, well, those earnings are going to halve or more than halve, then the real price people are thinking about is 10 to 15 times earnings. And so so what I want to focus the fact that look for a lot of the energy and commodity stocks that can give you that give you that head fake in terms of value. But that aside, obviously putting a value tilt into your portfolio is going to give you some extra value. Non-Eurozone Europe, so this is basically the countries like Switzerland, UK, some of the Nordic countries. You can get that. So basically countries that aren't on the euro, that's going to add in that extra bit of value from that, and partly a big chunk of that is the UK. Agribusiness is one that's sort of been looks cheap, but we've actually seen a number of downgrades again within that. And the other interesting one within that is gold stocks, in that gold stocks often sit as relatively cheap, but we've actually sort of seen that they haven't gone as far as the gold price. And this is the same issue that the gold price has rallied more than what we've seen within the gold stocks. And I guess it's a reflection that the gold stocks are not expecting that gold price to last as long. So that's your two-edged sword on that, is the markets are pricing for gold stocks as if the gold price isn't going to last as long. If you're a gold bull and you think it will, then maybe there's some room on those gold stocks for that to re-rate. So that's the absolute rank of value. But as I was sort of saying, there's some stocks within that are just always cheap, or always and so regardless of yes, the absolute value is there, that say energy stocks are cheap, but if they're always going to be cheap, then you don't get that benefit. So if you're looking at stocks that are cheap relative to their 5-year average, gold and coal actually both rate quite highly on that. But there's some other sectors sort of within that. Real estate is a little bit cheaper than what its 5-year average is. And that non-Eurozone Europe, Switzerland. And a lot of that's some of the healthcare stuff we're seeing within those. Interestingly as well, growth stocks actually sit in that, that the growth stocks are actually slightly cheaper than they usually are. So partly that is some of these ones like NVidia, where, and Meta and ones like that that I showed a little bit earlier, in that, let's take NVidia, is that it's been growing quite strongly, but because its growth has actually been strong relative to relative to what we saw in that graph, its pricing at the moment is below what you see. So quite often it was priced somewhere 30 times earnings to 60 times earnings over the last 5 years. Well, now you can buy it on closer to 30 than 60, and so it is a bit cheaper than what we've seen in the recent past. So so there's still some scope to add that into your portfolio and actually still add a little bit of value within your on a 5-year relative basis. Then if you're looking to sort of try and add some quality into your portfolio, well, naturally quality stocks is gonna get you there. It's really interesting. So on when I talk about these percentiles, what tends to happen is that if we're talking large cap stocks, so there's large cap stocks make up a huge proportion, like they might make up 80% of an index, and then the small stocks sit on the bottom, making up a smaller part, because indexes tend to be dollar weighted. So how much money is invested in the index. But then, so if we're trying to do ranking though, there's this thing about saying, well, if I've got a cheap stock versus an expensive stock, actually the size of it doesn't really matter as much when I'm trying to do the ranking. And so, and we rank within the sort of top 1,500 to 2,000 odd stocks globally. and that we sort of set that as our benchmark for the market. Then we say where do stocks sit. So large cap stocks tend to be more expensive than small cap stocks. And that's so when we're saying looking for value, you by buying large cap stocks, you're automatically going to be buying stocks that are a little bit more expensive and it looks a little worse on the value metrics. On the flip side, they tend to be a lot higher quality than small cap stocks, and a lot of this because their share price is less volatile, their earnings are often quite less volatile, and very much in the last couple of years, the growth has been better and more stable, and we've been seeing more upgrades in that sector. And so this sort of quality metric, what can you add into your portfolio to give it that higher quality, is basically the same stocks that performed over the last year. It's all those large tech stocks, the AI, information technology, growth. Interestingly, consumer staples sort of sits pretty high in terms of quality. Healthcare does, except the quality has been shrinking in the last year. And then there's a Sharia stocks, which is a religious thing. That's actually been relatively high quality as an exposure to add. And then if you look at versus its 5-year average, and so I guess this is less of an issue than what we saw within value. So within value, you might be looking and saying, okay, well, there's a sector within there, say growth stocks, and in growth stocks is quite expensive, but it's always expensive. And so I'm actually picking up at a little bit of a discount. So maybe that's a reason I might want to be using these. Often this quality rank versus the 5-year average. So that what this is showing is that the quality of these sectors has been declining over the last year. And so it's again that thought now, well, do I think the quality is going to rebound, or am I actually concerned that that I should be thinking about these stocks as to whether they're still as high quality as what they used to be. And so so we've seen some decline in quality in travel within the growth stocks as well, and then a few of those other defense contractors and stocks we can see throughout that. Right, I'll be back in just a sec.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. So I guess in summary, and sort of talking about this, what are you going to take away from here? Is a couple of main ones. Is for 2024, really what mattered was how much NVidia did you have in your portfolio, and for a bit of flavoring. The other sort of 6 or 7 odd large tech stocks as well. How much of those did you have in your portfolio? If you had lots, you're probably up 60, 70, 80% over the year. If you had none, you're probably down versus, or certainly maybe single digits or low double digits versus an SP 100 of 30 or 40 odd percent, depending on including Aussie dollar or not Aussie dollar effects. So for next year, and so despite that though, we really saw the earnings come through for those companies that were rallying, and so that's the key part to watch now. If the earnings starts to slow down within those sectors, then there's some warning signs. If you keep seeing those fundamentals and the earnings coming through, then we're looking to sort of keep, accumulating if we see the markets dip from here. So 2025. There's obviously a lot coming with the Trump and new policies coming through, and we'll go into that in more detail in future weeks. But so the broad base is really keeping an eye on these fundamentals, seeing if we keep seeing the performance coming from those growth stocks, the fundamental performance coming from those growth stocks, and if so, we're happy to own them as long as the valuations don't get crazy and the valuations are really aren't that crazy for most of those stocks at the moment. Thanks for tuning in. So just a reminder, you can get us on a whole bunch of different podcast platforms, Spotify, all the usual ones. Sorry, let me bring that up as a Apple Podcasts. We're on a whole bunch of different social medias as well. You can follow us on those to get updates. And if you go to nucleuswealth.com/content, you can register for our weekly email, and we'll send a lot of our thoughts and processes out. Especially if you want sort of some more information on what I've got. There's a report which we've got coming out, which goes into a lot more detail about the types of tilts and what other factors you can get. And if you're looking to sort of try and move your portfolio around and get exposure to particular themes, that would be very useful for you. Thanks, everyone, and we'll see you next week. We're on every Thursday usually, so apologies for the late one today, but today rather than yesterday, but usually it's Thursdays 12:30 on this on YouTube podcast. Thanks, and we'll see everyone next week.